Today, I'd like to talk about yesterday's video. I got a lot of comments from both TikTok and Twitter. I'd like to welcome my Twitter followers. I think I've been over there about 3 weeks. I have about half as many followers on Twitter as I do on TikTok, and that's been mainly because of Michael from Lead Lag Podcast, where I did a podcast with him, which I'll post onto my YouTube page. But I want to thank Michael for what he did there, and I want to thank all the Twitter people for starting to follow me. Now, I made some assertions yesterday about inflation and employment, and there were a lot of comments on that. So, let's go and let's just deal with the inflation one first. So, basically, the comments on inflation was just picking these numbers out of the air. Well, here's how I feel about that. One is, starting in late 2019, as you know, we threw $5 trillion into our economy. Now we've taken out about $1.8 trillion over the last couple of years, but basically we never ever did this before. So this is historic, and we still don't know the effects of this long term on how everything works out. As for the inflation rate, here's the inflation chart for the United States. Now, frankly, I got hired literally at the bottom there of the first downturn there back in the mid 70s, and my entire first 7-8 years was in an inflationary environment. No one knew what inflation was. We had no clue. Everyone was arguing about it. It was a very tough time. We had stagflation. As a financial advisor, we were brokers then. I sold gold, silver, and oil trusts. That's it. No one would buy anything else. They wouldn't buy stocks or anything like that. I think people need to remember, you go back to look at the Dow Jones in 1947, I think it went down to during the recession that we had, 862, okay? And if you go and look in 1982, I think the Dow was 882. So 20 points in 25 years. So times change, different things out there. I'm just saying, I believe that we're finishing the first wave and about to enter the second, and then there'll be a third wave. And given how inflation went up in the 70s without any QE, I think that we'll probably surpass those inflation numbers. It's just my opinion. You can do what you want. Now, I believe that this discussion on the employment, if you think about it, the narrative 3 or 4 weeks ago was inflation, inflation, inflation. Well, the numbers came in and they were much higher than people anticipated, and guess what? No one even talks about inflation. Yesterday, Goolsbee, one of the Fed guys, actually came out and literally said this. He said, look, even if we get an uptick in the CPI, we're not going to pay attention to it because of the overall trend is downward, okay? It's insane, all right? I can't believe he's the Fed governor. Now, here is the yield curve. We've had 8 recessions since 1955, and guess what? Every one of them has started with an inverted yield curve. An inverted yield curve is when the short term is yielding more than the long term, and when it reverts back, its inversion, then supposedly that will be the kickoff of the recession. Well, here's our inverted yield chart, which maps each one of them out. I think the biggest outstanding thing is that we had the inverted yield curve for the longest time, 783 days. And this is when the 3-year went slightly lower than the 10-year. We'll show that in a moment. But as you can see, this was the longest time we had an inverted yield curve. Now, for all you economics majors out there, I thought that it was only on the 3-month. But when you read through, people say it can re-invert if the 2 or the 3-year actually goes lower than the 10-year. Frankly, I always thought it was the 3-month, but who am I? So I'd also point out that the inverted yield curve that came in the 80s was actually, I'm going to say it was artificial. This was the Volcker decision. And I'll do a video on that someday. 'Cause fascinating what happened then. So really, this one, even though that was 623 days, we actually manufactured that. We didn't manufacture this. So supposedly, this is going to kick off the recession. Okay, again, I don't know. And you can see here was the Financial Times last night at the end of Friday night. Okay, and they're saying stocks turn in their worst week in 18 months, and a slowdown fears amount. Okay. So what does this mean to us? Okay, to me, we develop narratives, right? The narrative is that we're heading into a recession, which we could well be going into. What it is we just don't see any signs of it yet. And if you read the Fed governor's statements and follow me on Twitter, I printed them all out yesterday or reposted them yesterday. They say they don't see a recession. They don't see one coming now. One Fed governor said unemployment might be 4.25 by the end of the year, all right? Minimal, okay? So the real question is what do we think? What we're trying to find out is what is going on right now, right? So when you think of risk, how do you think of risk when we have so many things that could happen to us, all right? We got the yen carry trade, we have the deficit, we have politics, we have geopolitics, we have deglobalization, a lot of things going on, which could affect the stock market, and they do affect the stock market. So when you think about risk, the way I think about it is you got a mile away, you got a guy with a gun. 1,000 yards away, you got a guy with a bow and arrow. And 500 yards away, you got a guy with a knife, okay? And then 100 yards away, you got this big dude that could beat the hell out of you, okay? Which one is the worst risk? That's your decision, okay? What I'm saying is we went down because people are now afraid of the slowdown, okay? Well, think of this. Just a couple weeks ago, this market cracked. And when it cracked because of the yen carry trade, okay? And we came roaring back, no question about it, all right? But the yen had gone up. And now the yen is actually higher than where it was before when we cracked. So my question is we just had the worst week since March of 23. Think about that. What happened in March of 23? Oh, it was St. Pat's Day. And it was also when we had the banking crisis. So do we believe the banking crisis is over? Or did something happen this past week that we're not aware of that caused this to happen? Now, the yen carry trade, we had a bad day that day, but if the yen carry trade is half as big as people think, and people think it's between $4 and $20 trillion, it's going to take years, some people think a decade, to unwind. So with the yen going down last week, or up, okay, down to 142 is up, are the other people in the yen carry trade being forced out? And when you say forced out, that means they have to sell their dollar-denominated investment, bring them back to Japan, and buy back their yen position, okay? So what happened this week? We had the worst week in 18 months, and they're blaming it on a 4.2 unemployment number. What do you think? I think it's insane, but like and follow and give me your comments.